Hi, I'm Eileen Duff, and this is Beyond 6040. Today, I'm joined by John Wuestling, partner at StepStone Group. John is a member of the private equity team focusing on venture capital. Managing over $30 billion in assets, StepStone Venture invests in funds and companies on a primary and secondary basis across all stages. Welcome, John. Thank you so much for being here. It's great to see you.
Thanks, Eileen. Great to be here as well.
So tell me a little bit about StepStone and what sets you guys apart.
StepStone is one of the largest private market specialists. We manage about $180 billion in assets on a discretionary basis. But I think what sets us apart really simply is that we're one of the largest allocators to funds in the world, really across every facet of the private markets. We do our best to leverage the data that we glean by virtue of being a large fund investor and build deep relationships with managers to then use that information to invest directly in companies and to underwrite secondaries effectively.
Maybe let's talk a little bit about the market environment and how you see that affecting venture today. Take, for instance, tariffs or any of the other trends that you're seeing. How is that really impacting the venture market?
Lots going on the macro side. I think tariffs most significantly in venture really impacted liquidity. It's hard to go public when you're worried about what's going to happen on a day-to-day basis, tariffs included. So I wouldn't say that venture is that affected by tariffs in that most venture-backed companies are asset light, software, AI, security, less impacted than traditional industries. But again, going back to broader macro tailwinds, limited liquidity, hard to get ready to go public, hard to prepare yourself when you're not sure what's going to happen day to day.
Yeah, like what's happening with the lack of IPOs in the venture space?
I think there's two kind of main knock-on effects that come from that. Number one is investors in venture are sitting on a lot more net asset value or a lot of unrealized value. NAV in venture has reached $3.8 trillion.
Wow.
That's about the size of France's GDP, which is pretty wild. So when you don't have natural liquidity, what do? You have to manufacture your own liquidity. So secondaries are becoming an important tool in venture to generate interim liquidity. So I think that's one knock on. And then the other hope is just businesses continuing to plan for hopefully what will be more successful IPOs as macro continues to kind of moderate. We saw a rate cut. The impact of tariffs is starting to wane, et cetera.
So you touched on secondaries, and I think that's really interesting considering how big StepStone is in the secondary space. What other trends are you seeing that you think are going to drive growth in the venture market?
We haven't really touched on AI. I think obviously, ventures ability to produce outsized returns really come from two things. It comes from the macro dynamics at play when you're investing and when you're exiting, but arguably more importantly, the foundational tech trends that are going on. I'd argue that tech trends of 10, 15 years ago are a lot more incremental than AI. I mean, AI is obviously having an impact on our daily lives. And it's not just LLMs. It's not just OpenAI and XAI and Anthropic. It's, security companies that are securing large language models. It's, software businesses that are introducing AI add-ons to their product. In other words, the addressable market and the addressable universe through the AI wave is just massive and hard to quantify.
And you guys are finding ways to access that through lots of different companies.
Exactly. And again, that goes back to this idea of it's not just the large language models that we read about in the Wall Street Journal. We have a legal tech software company where they own incredibly rich data on how their constituents are interacting with their software. So they've introduced AI agents, they've introduced AI tools, and that's driving significant revenue growth, which wasn't there, 5-10 years ago before the AI boom of today.
So you've been in venture the majority of your career. Talk to us a little bit about how the market is evolving and really why you think this is so important in a private wealth portfolio.
When I entered venture, the thought of venture being an asset class accessible to high net worth individuals was sort of unthinkable. Venture was dominated by the Harvards and the Yales and the MITs of the world. It was an asset class that was often called an access class. A small number of managers drove an overwhelming amount of the overall returns to the industry, and they were closed to new investors for a long period of time. The good news is today, that accessibility has expanded and the overall venture market has expanded dramatically. So it's not just investing in early stage venture. You can do venture secondaries, you can do co-investments. So I think market expansion helps make venture appropriate for private wealth clients. I also think innovation in structure and design, 1940 Act funds help ensure that clients are getting fully invested on day one, that there aren't K1s, that there aren't capital calls. So I think it's a combination of accessibility and structure are making venture much better suited to private wealth these days.
And you mentioned access. I wanted to touch on, you recently wrote a white paper shedding the access class label. Talk to us a little bit about what that was driving that.
We jokingly sometimes refer to venture as an access class. The reality is the venture market has evolved and grown so much since that term was bandied about, 15 years ago. Yes, there are well-known venerable brands that have been around for a really long time, those on Sand Hill Road that we all know, but a larger percentage of emerging managers are driving the outperformance of the industry. We've looked at data of the top 10 performers in certain vintage years, and often 50, 60, 70% are newer funds. So we're just arguing that setting it and forgetting it and just allocating to those quote unquote branded GPs, it's not going to produce the same success as it did 10, 15 years ago.
And you guys are finding success with general high net worth investors. I mean, in previous years, it might have been foreseen that venture was too risky, perhaps.
We have purposely designed strategies that we believe are risk mitigated and well suited to the high net worth universe. We touched on secondaries, but if you think about what secondaries do in a portfolio, you're buying into companies or portfolios of companies where the underlying assets are mature. And in venture, oftentimes the mediocre companies are written off early or are exited for mediocre outcomes early, and you're left with a pretty strong mature portfolio. You can wrap your head around those companies, you can underwrite them more effectively. So loss ratios get diminished as you invest in secondaries, J-curve gets mitigated, capital gets returned more quickly. So I think some of this is like investing in the right structures and the right strategies that are more appropriate for high net worth.
So it sounds like a terrific way to access an asset class that maybe, 10 years ago wasn't so easy for high net worth individuals to access.
I think that's exactly right. I mean, high net worth individuals don't have the same time horizons as endowments or hospitals.
Sure, yeah.
The individuals that our firms cater to on the high net worth side have real life needs and things to consider. So it's very important to structure a fund, structure a solution that bears that in mind.
Well, I think we'd agree with you, John. This has been a fascinating conversation and really appreciate you joining us today. Again, I'm Eileen Duff. That's 60/40, and we look forward to seeing you next time.